Welcome back to the Neuro Finance Masterclass. I am absolutely thrilled to be here with you today for day 44 of our 365 Days to Financial Freedom series. Yesterday, we laid down some serious foundational groundwork, didn't we? We equipped you with the price to earnings, or PE ratio, we crunched math together, and we taught you how to filter through all the market noise to find companies that are, mathematically speaking, cheap. Now, if you're like most architects in our masterclass, you probably walked away from that session feeling pretty confident. You're armed with a shiny new metric, ready to hunt for bargains out there. But today we need to have a deeply analytical, cautious conversation, because in this explainer, we're tackling one of the most sophisticated lessons you will ever learn on Wall Street. As you'll see, the concept of cheap can be incredibly deceiving.
Think about a PE of 5. On the surface, applying exactly what we learned yesterday, that looks like the holy grail of investing, right? The math literally tells you it's a massive bargain. It's practically being given away. But let's hit pause for a second. A shockingly low PE ratio like a 5 is not automatically a bargain. In fact, it's often a glaring, flashing red warning sign. It's the market communicating to you that this is not a healthy business on sale. It's a business in fundamental decline.
Section 1. The dark side of PE. Not everything cheap is a bargain. This introduces a dangerous concept we call the value trap. And let me tell you, mathematical cheapness can act as a brilliant disguise. So what exactly is a value trap? Well, it's a company that looks incredibly attractive on paper. It often boasts a ridiculously low PE ratio. And to make the bait even sweeter, it might even pay out a massive dividend. This right here is exactly where amateurs get completely wiped out. They rush in, genuinely believing they've discovered a secret gold mine that the rest of the market has somehow foolishly ignored. But here is the harsh reality. You aren't stepping into a gold mine. You are stepping right into a trap. Falling for this is the tragic mistake that separates the amateurs from the true architects. What looks like an easy, mathematically guaranteed win is actually a carefully disguised financial bear trap. The company is fundamentally declining, and that massive dividend they're using to lure you in, it's entirely unsustainable, and it'll likely be cut to zero the very moment the underlying business realities catch up with the balance sheet.
Moving right along to Section 2, the obsolescence illusion, the DVD rental warning.
You absolutely must learn to distinguish between a company that is temporarily undervalued and one that is fundamentally broken. Imagine looking at a massive, nationwide DVD rental company right at the exact moment before online streaming took over the world. Their past profits, they still looked okay, and because of those past profits, their PE ratio looked incredibly low. They looked like the ultimate bargain. But their entire business model had been rendered completely, irreversibly obsolete by new technology. Now, compare that to a temporarily undervalued company. That's a highly functional, solid business that just got caught up in a broad market panic. People still actually need their product. The key takeaway here, no amount of good management can save a fundamentally broken company when the world simply no longer wants what they're selling. The reason this happens is simple, but absolutely crucial. The stock market is forward-looking. The PE ratio is calculated using past earnings. But Wall Street only cares about what a company is going to do tomorrow. Institutional investors, the massive funds that actually move the market, aggressively push the price of these obsolete stocks down because they know the truth. They know the company's earnings are going to absolutely collapse next year. The stock isn't cheap because it's a secret bargain. It's cheap because the big money knows the profits are about to evaporate.
Section 3. The architect's filter. Ask the why behind the math.
This brings us to the absolute most powerful Socratic question you can ask yourself as an investor. Why is it cheap? When you see that PE of 5, do not immediately click buy. Stop. Demand an answer to this question. You have to force yourself to engage critically here. You must look past the pure mathematical valuation and investigate the underlying operational reality of the business. To answer that why, you've got to investigate. Ask yourself 3 things. First, is it just a broad market panic? Look, if the whole market is down 20%, maybe this great company is just caught in the rip current. That's a potential buy. Second, is the core product becoming irrelevant? Are they selling DVD rentals in a streaming world? If yes, walk away immediately. And third, is there massive unpayable debt hiding on the balance sheet? A low PE ratio is merely an invitation to investigate further. It is not a guarantee of wealth. You absolutely must combine your mathematical valuation with deep, critical business analysis. And finally, Section 4. Today's action plan. Audit your cheap investments. It's time to execute, because we don't just learn theory in this masterclass. I want you to take out your portfolio or your watch list and ruthlessly audit the companies you thought were bargains. Step 1. Assume the market knows something you do not. This requires humility. If a stock is shockingly cheap, assume there is a fundamental flaw until proven otherwise. Step 2. Research the company's debt. Are they drowning in loans they can no longer afford to service? Step 3. Check the competitors. Are faster, more innovative companies eating their market share? And finally, Step 4. Analyze the future industry outlook. Is the entire sector growing, or is it slowly dying off? Use this rigorous checklist to filter out those dangerous investments.
Ultimately, I want you to remember this. A true architect buys value, not garbage. Literally, anyone can find a mathematically cheap stock. It takes zero skill to sort a spreadsheet by the lowest PE ratio. But elevating your analytical critical thinking, investigating the underlying business, and having the discipline to walk away from a dying company disguised as a bargain, that is true mastery. So audit your watch list today. Ask yourself, are you buying true value or are you just stepping into a trap? We will see you tomorrow for day 45.